Welcome to the Deep Dive. Today, we're really digging into the numbers behind a business, specifically G Company's financials from year one and year two. Think of this as your quick guide, to figuring out if a company's doing okay. We've got their data, some competitor info, industry averages too. Our mission, simple. Pull out the key stuff on profitability, liquidity, solvency, and performance. And why does this matter to you? Well, understanding these signposts is a shortcut, really. Saves you wading through tons of pages.
That's right. Financial analysis basically boils down to using this data to answer some, fundamental questions about a business. We focus on key ratios from these statements, and that gives us a clearer picture, especially when you compare them past performance, industry peers.
Okay, let's jump in. Profitability. How good is G Company at actually making money? First, gross profit margin. Year two was, 44.4%? Just a tiny bit down from year one. So are they making slightly less per sale after direct costs?
Slightly, yeah, but not significantly less, that tiny dip. It suggests their core operation profitability is pretty stable. Generally, higher is better here. Shows efficiency. If it drops sharply, we'd definitely ask why costs are rising faster than sales.
Got it. What about the overall profit margin, the bottom line? That actually went up a bit from about 10.6% to 11.1%. Positive.
Yes, definitely positive. That small increase means G Company got marginally better at turning sales into real profit after all the expenses. That little bit extra helps with reinvestment or paying shareholders.
Okay. And using their assets to make profit. Return on assets, ROA. It was 7.19% in year two. What's that telling us?
Well, think of it like this. For every dollar of stuff G Company owns or controls, they made about 7 cents in profit. Generally, a higher ROA means better efficiency, using what they have effectively.
And for shareholders, return on equity, ROE. That jumped to 14.2%. Good news for investors.
Absolutely. A higher ROE like that. It means shareholders are seeing a better return on the money they've put in. Suggests G is using that investment well to generate profit.
All right, let's switch gears. Liquidity. Can G Company pay its immediate bills? Their current ratio, year two, was 1.03, down from 1.09, and the industry average is 1.5. Sounds like they might be a little tight.
That's a fair reading. Yeah. A current ratio below average suggests they have fewer liquid assets, cash, receivables compared to immediate debts. It's a potential flag compared to their peers.
And the quick ratio, even stricter, excludes inventory that also dropped. 0.61 versus an average of 0.80. So if they can't sell inventory fast, they're in a tighter spot.
Exactly. The quick ratio is more conservative. And it being below average, too, it reinforces that potential short-term liquidity concern.
And their cash conversion cycle, almost 112 days. Seems long to turn inventory back into cash.
It is quite long. It means cash is tied up in that whole process, buying, making, selling, collecting. You'd ideally want a shorter cycle, frees up cash faster.
Okay, now solvency. Long-term debt situation. Debt-to-equity ratio went down to 0.92, so less reliance on borrowing versus shareholder funds.
Precisely. Lower ratio usually means lower risk, less debt compared to equity. Good sign.
And the total debt ratio, showing how much assets are funded by debt, that also decreased.
Right. So less of their total stuff is paid for with borrowed money.
Right.
Points towards, better long-term stability.
And times interest earned shot way up. Over 31 times.
Yeah.
They can easily cover interest payments then?
Oh, absolutely. A much bigger cushion there. Significantly reduces the risk of not being able to pay their interest. Very strong number.
Last section. Performance metrics. Earnings per share, EPS, went up. $2 from $1.80. Clear win for shareholders.
Yep. More profit per share. That's what investors like to see.
Price to earnings ratio, PE, was 6. That seems low. Does it mean the market's not that optimistic?
It could mean that, yeah. A lower PE might signal undervaluation, or maybe the market sees lower growth ahead compared to others. It's one of those metrics that really needs more context,
Okay. And asset turnover.
Yeah.
0.65. How efficiently they use assets to make sales.
Correct. For every dollar in assets, they generated 65 cents in sales. Higher is generally better, more efficient use of assets.
So wrapping up, we've hit profitability, liquidity, solvency, performance for G Company. It's clear these ratios give you, the listener, a much faster way to grasp the story. But you've got to compare them, right? Over time gets competitors, industry averages?
Exactly. The numbers alone are just points. The power is in the comparison, the trends, the context. They help you ask smarter follow-up questions.
So for you listening, this was a quick tour of financial statement analysis, a toolkit to start making sense of company financials.
Which brings up a final thought, maybe. How do all these different ratios, these pieces of the puzzle, fit together for this company, G company? What's the bigger picture they paint, and what deeper questions do you have now about their future?